I am going to revisit a theme that I had done about a year ago in a video when I asked the question, is the CFA charter worth the effort? And I'm going to redo it, not so much redo it, but revisit it now in light of what has happened over the past few exams with the lower pass rates. And, whether or not you attribute the lower pass rates to the characteristics of the test taker, which is the argument being put forth by CFAI that those that are deferred are getting lower pass rates, bringing the group down, or whether or not you have a belief that the lower pass rates are a result of the characteristics of the exam. The questions are harder, there are fewer questions, and the minimum passing score is increased. These are all theories that are out there. So let's revisit this question in light of the perception that it may be the exam, and in light of the perception or the actual reality that it may be the characteristics of the test taker. We'll try to revisit the question assuming that all of those things could possibly be true. Now, if you go to the CFAI website and you look at a lot of the preamble they have about the charter, one of the conclusions they list on the site is that having it leads to higher salaries in your career. That is a half-truth. It's not false, but it's not completely true the way it's stated. What I'd like you to do, if you have time, is go to Google Scholar and type in Chartered Financial Analyst, effect on job, effect on salary, effect on whatever you want it to be. There isn't a big body of research on this, but there are 4 or 5 papers that have been written that look at the effect of having the charter on certain things. Some look at it in terms of having the charter in pay. Some look at it in performance, job performance and outcomes. Some look at it in terms of job satisfaction. So I'll try to summarize the main points of these and then distill it down to probably what the main causal factor is. And then we'll ask the question, or we will be able to answer the question, is the charter worth it once we have that? Let's look at pay. And the one paper that I read looked at the difference between charter holders and non-charter holders in specific jobs. And they found no significant difference. Now, what they found was if you were a portfolio manager with a charter holder, you made no difference in income than portfolio managers that did not have the charter, but that portfolio managers made more than another job category. But within that other job category, whether you had the charter or didn't have the charter, had no effect on your pay. So that pay was related to the job type more so than it was related to the characteristics of the job holder. What the charter did do was it allowed you access to those higher level jobs that you might not have otherwise had, that there was some relationship between access to the job and having the charter holder. So when we say that it leads to higher salaries in your life, it's not for the same job. It leads to higher salaries because it leads to jobs that are at a higher level that you might not have had access to. However, that's not entirely true either. When academics look at a body of literature, usually there's studies related to this, to this, to this, all these different variables. And some academic will come along and say, okay, well, I'm going to do a meta-analysis, which means I'm going to take all of these and I'm going to bring them together and see if there's some consistent theme across all of them. So I'm attempting to do that here. Another one looked at outcomes, job performance. Are charter holders better at their jobs than non-charter holders? And there was a list of criteria of what metric they would consider. And it turns out that in certain types of performance, charter holders are better than non-charter holders. Charter holders tend to build more diversified portfolios. They looked at asset managers and analysts. At the asset manager level, they tend to build more diversified portfolios. which means that they had an eye towards risk. They were more risk aware than non-charter holders in that sense, and they were more asset aware. In other words, they had a broader view of the universe of assets that could be used than non-charter holders. So they had a bigger view and they were more risk aware. Okay, well, that's a good thing. For the analyst, they found that charter holders tended to update their recommendations faster than non-charter holders, but found no difference in whether or not you were right or wrong. However, we have to sort of look at a causal map on this one. If charter holders are updating their recommendations faster than non-charter holders, it could be that non-charter holders are influenced by the charter holders' change in recommendations and then change theirs to match, thereby providing no difference. What it does say is that charter holders are more aware of the signals in the environment and can respond to them faster. That they can spot the signals in the environment that would lead to a change in recommendation and would update the recommendation in response to that. Good enough. If you can get me out of a trade faster or into a trade sooner, good enough. I'm good with that. And then we have job satisfaction. Charter holders, statistically speaking, when we look at job satisfaction, we're statistically significantly different than those that didn't have a charter. They were more satisfied on their job than those who didn't have it. However, I don't think it is the presence of the three letters that make you more satisfied with your job. I think it is your better job performance that makes you more satisfied with your job. We're always satisfied with stuff we're good at. If we're not good at something, after a couple hours, you ask someone, are you having any fun? Sorry about that. I have all Apple product, and when the phone rings, all my devices start ringing at the same time. It can be really frustrating because you can't compartmentalize where all your devices are and leave all the noises at one side. Anyways, okay, so what have we got? We've got charter holders tend to have better performance on certain metrics. Charter holders tend to have better access to jobs than non-charter holders, and they tend to be more satisfied on their job. So when we bring that all together, let's look at the effect of having the charter. Do the three letters lead you to higher paying jobs? No. The process of going through the curriculum to get those three letters lead to better job performance. Better job performance leads to access to higher paying jobs. So when we ask the question, is the charter worth it? It is worth it only if it makes you better at your job. That's it. If it doesn't make you better at your job, then it's not worth it. Now, if you approach this in terms of, do I have to read the book? Can I just watch the videos and can I pass the test? How many hours do I need to put in to pass the test? Pass the test, pass the test. If I do this, can I pass the test? Pass the test. What's the minimum I need to pass the test? Pass the test. Well, you're looking at passing the test as the goal, not the outcome. Chances are you're going to miss all the richness of the content and it will not make you better at your job. So if you've been through level 1 and if you've been through level 2 and you find that on your job your performance has not changed at all, that your performance is the same, that you're not being noticed for an increase in performance, maybe you're approaching this the wrong way. And if you are going to continue to approach it the wrong way, then yeah, it's not worth it, because it's not the three letters that lead to job satisfaction. It's not the three letters that lead to higher pay. It's the process you go through that leads to better job performance, which leads to higher pay because you have access to better jobs. It's all channeled through job performance. So if you're drawing a path diagram, the mediating variable for everything is job performance. Job performance leads to everything else. Everything else is an input to that. So you have to look at this process as an input to job performance and not keep focusing on, if I just get those three letters, I'll get more money. Doors will open and I'll be in charge of this much money and that much money. your job performance will. So let's say that you find a way to improve your performance on the job without doing this. Is this worth it? Probably not, because everything comes through job performance. Whatever improves your job performance is worth it. This is one thing that can improve your job performance if you see it that way. But if you see it as something you've just got to get through, something you're going to squeeze in, you just got to get those 3 letters. That's all you want to do. In the end, if it doesn't change your job performance, all you've done was make your name longer. You spent some money, lost some time, and made your name longer. And that's it. So what I'm going to do is I'm going to combine an applied series in with this. I'm going to apply something from level 3 called goals-based investing. And the premise of that is, if you talk to individuals about their investments and you use the language of finance, here's the expected return, here's our strategic asset allocation, it has this level of portfolio volatility, we have a Sortino ratio of this, you have a Sharpe ratio of this, we can expect a value at risk, maximum, you're going to lose them. It's too technical, you're simply going to lose them. Over time, we have found that when we're talking to individuals, it is better to talk in terms of what an investment can do for them in the future. What goal can be achieved by investing in this portfolio versus this portfolio? So we say, well, what would you like to do in retirement? What does that look like for you? And they describe what their retirement looks like. And you say, well, this portfolio over here can get you there. How important is it for you to get there? And they might say, well, it's really important. So like, you want a 95% probability of making sure that happens? Yeah, that sounds good. Okay, well then this portfolio is the one you want. Now, you don't have to talk to them about the technicalities of the portfolio. You don't have to talk about the strategic asset allocation, the volatility, the drawdowns, the Sharpe ratios, risk adjusted. You don't even have to get into the technicals. All you're doing is saying this portfolio aligns with your future goal. If you invest in this, you will be able to do that in the future. Okay, let's talk about this process in terms of goals-based education as opposed to the 3 letters. We'll change it from goals-based investing to goals-based education. What can I do with this thing? And it comes down to one equation. One simple equation draws out the entire 3 levels of what you're about to do. And you simply just have to decide what pathway you're going to go on. You're either going to agree with the equation, and it will set you on a particular pathway, of which is perfectly covered in all the 3 levels. I'm going to show you how all of the content is going to matter if you agree with the equation. If you disagree with the equation, well, guess what? It still matters, but it's different stuff that matters. So there are 2 pathways, and there are 2 broad beliefs in these 3 levels, and these 2 broad beliefs come down to one equation, and whether you believe that equation or whether you do not believe that equation. So let's go to the screen and do that. Okay, I think many of you will recognize this equation. It is introduced very early at level 1. It is saying that the return on, I'll just put I, any asset, any portfolio, and we'll subtract the risk-free rate. And this is an excess return. That the excess return that can be achieved on any asset or any portfolio is directly proportional to the level of systematic risk. And we can measure that by a beta coefficient multiplied by the return on the market minus that risk-free rate. So this is the excess return on the market. This is the excess return on the asset. The thinking behind that is, well, listen, you can diversify away idiosyncratic risk, and if you can diversify it away, all you'll be left with is the market risk, of which you can't avoid, and all assets will be rewarded in relation to their sensitivity to the market. And you either believe this or you don't believe this. One of the conclusions from this is that if this is the market portfolio and you have investor A over here and investor B over here. Now, the market will return what the market returns, by the way. That if A decides to overweight something, by definition, if you only have two investors in a marketplace, B must be underweight that very thing, such that within the market you'll have certain securities that do better than the market, certain securities that do worse. Because of this relationship over here, one person's residual return, and a residual return is the return above what the excess return would say. That one person's residual return is another person's residual loss. Therefore, what we have here is a zero-sum game. That in any portfolio, you'll have winners and losers, and over a number of years, all those winners and losers will offset each other such that in the long run, you can only return the market portfolio. Attempting to outperform the market portfolio is a loser's game because you will subtract higher fees and you will have a higher tax drag through more realized capital gains. So that you have to be so much better to overcome the fees and the tax drag, and it simply can't be done. In fact, there is a documentary out there called The Loser's Game. It conceives of the market as a zero-sum game, that the gains that accrue to some people, because of the nature of the market return being the average return, must come at the cost of some people losing. You either believe that or you don't believe that. Now, if you believe that, then you are on team passive. Yeah, there are two teams here. You are on team passive. And if you're on team passive, you may think, well, there's nothing to do. I don't need to know any of this stuff because I simply just buy a portfolio or an investment that tracks the broad index and I'm done. Well, that's if you're an investor, but we're not training you to be an investor. We're training you to be in the industry to provide these products. There is a lot to be done. You have an optimization problem. You have to minimize your tracking error while minimizing costs. Well, you can't get that done. The more you push on this one, the more you're going to lose this fight. The more you push on this one, the more you're going to lose this fight. So that's going to push you into something called enhanced indexing. Now, with enhanced indexing, even though the portfolio will be passive, there are a whole bunch of active decisions that come up front. How are you going to enhance? Maybe you'll say, look, I just need a subset of all of the securities. So you're going to have to find a way to arrive at a subset that has the highest correlation with the returns of the entire index. Well, you're going to have to understand statistics and you're going to need some quantitative tools to get that done. Correlations do change over time as well. So whatever subset you have may not have a stable correlation with the portfolio. So you're going to have to probably move into an algorithm that learns over time. Once you're done that, you're going to need some very good portfolio construction techniques. Are you going to construct your portfolio by sector, by asset class, by factor exposure? Well, if you're going to do that, you're going to have to understand factor models. Well, what kind of factor models? Fundamental factor models? Macroeconomic factor models? You're going to have some understanding of that. If you're an advisor saying, well, I'm not going to do all of that stuff. I'm just going to advise people. I'm an advisor and I'm going to put them into passive investments. Well, which passive investments are you going to put them in? How are you going to evaluate them? Do you understand what tracking error is? Do you understand what the fees are? Do you understand what that means over a long period of time? What is the drag on performance going to be? How do you evaluate? Let's say that you are a sponsor setting up something. How do you evaluate passive managers? So you're going to need to know something about performance evaluation. Which asset class? Well, we don't know, so you better learn something about fixed income, you better learn something about equities, you better learn something about alternative investments, and you better know how to use derivatives. Because if you have a passive portfolio and you have a huge sum of money coming into that portfolio, until that money can be deployed, you're going to introduce tracking error into the portfolio, so you better know how to equitize cash and then slowly deploy your cash over time. So there's a lot that you have to know. Well, let's say, you know what, I disagree. with this altogether, because it totally discounts ability. It ignores the distribution of ability across individuals. Maybe I'm just better than the average. Because, of course, this is an average of all the returns. That's the market return, and I'm better than average. I can consistently outperform the excess return. In other words, I can produce what's called a residual return. And a residual is the return, we'll call it at the portfolio level, minus the return on whatever benchmark we have being greater than zero. And when I say greater than zero, greater than all of the fees necessary to produce that, I can produce residual returns because I have ability. Well, then you are on team active. And on being on team active, you're going to build a portfolio. You can build it from the top or you can build it from the bottom. Doesn't matter which way you want to go. If you're going to build it top down, you better have a good firm understanding of economics. If you're going to build it from the bottom, you better understand how to read balance sheets, and you better understand how businesses make decisions, which means you're going to need some introduction to corporate finance to determine, well, how does a business determine whether it's going to use debt or whether it's going to use equity? That's important for me to know. And then, of course, you're going to build your portfolio, but you also need heavy portfolio management skills on this because you now have an active portfolio. You're going to have to determine how your performance is going to be judged. So you're going to need some kind of model on which you look at performance attribution, because somebody is going to evaluate your performance. Or if you're a sponsor of a fund and you have to allocate fund to an active manager, you better know how to evaluate that particular manager. So there's a whole bunch of stuff at level 3 on manager selection, performance attribution that you're going to need to know. So no matter what team you're on, whether you're on team active or team passive, you're going to have a firm basis in quantitative analysis, or at least a very good understanding of it, so that you can read reports and you can also talk to people who generate this output. And the big tools you're going to need there are a good understanding of the different types of distributions that are typically used in finance, an understanding of regression, because that is how we get our beta coefficients. That is also how we get our factors if you're looking at factor-based investing. And time series analysis, because if you're doing anything with economic data, time series is usually the more relevant application there. You're going to need to understand FRA, because there is no other way to do bottom-up investing other than to look at the individual companies themselves. You're going to have to understand corporate finance, because you need to know how companies make decisions. Now you may say, well, I don't need to know any of this for passive. Well, yes, you do. If you're using a subset of the securities in the index, you can get to that from a quantitative model, but you can also just look at the results and say, well, you know what? I have enhanced indexing and I am allowed some slight deviations from some of these sectors. So maybe I'm pretty aware of a particular company that I say, you know what? I just don't see them making it this year. Let's just underweight it. So you better have some understanding of that even for the passive side. Economics is big. Economics is big for both active and for passive, especially if you are allowed some deviations from the benchmark, still trying to minimize your tracking error, but you're allowed enough active decisions to cover off your costs. Well, having some forecast of where we're headed to might give you some indication of saying, okay, I'm going to track the benchmark, but I'm going to be slightly underweight these sectors and slightly overweight those sectors, because this is what I see happening in the 12 months coming ahead. Passive, again, does not mean no active decisions. It just means all the active decisions come before portfolio construction, and after you construct the portfolio, then it simply just tracks the index. You better have your asset classes right: fixed income, equities, alternative investments, and you better know how to manage risk. The best form of risk management is through derivatives. You better know how to construct a portfolio. You better know how to rebalance and reconstitute a portfolio. That's what you're going to get in portfolio management. So it does not matter whether you agree or disagree with this equation. That is the only question. Do you believe it? If you do, you're on Team Passive and there's a lot to learn. If you disagree with it, you're on Team Active and there's a lot to learn. At level 1, at level 2, and at level 3. So if you are on one team or the other and you think that only half the stuff applies to you, you're wrong. It all applies to you, but in different ways. And you have to determine, how does this make me better at being a passive asset manager? Or how does it make me better at being an active asset manager? So, in tying this back to what I originally started by saying we would do, goals-based education, and tying it back, the goal from what we see here is not to pass 3 tests and get 3 letters. The goal is to be the best player on Team Passive that we possibly can, or to be the best player on Team Active that we possibly can. If you want to see what this can do for you on my channel, well, you're obviously on my channel now, click on playlists, and there's one playlist for the Applied series, and everything in those videos is right off the pages of the content that you would read. It is applied directly off the pages, why it's called the Applied series. So that is a good move towards goals-based education, is rather than say, if you watch this, you'll pass this test. It is rather saying, if you watch this, you'll have this capability. You'll be able to do this. This is the goal you'll be able to achieve. When you're looking at your journey through these 3 levels, try less and less and less to look at it in terms of getting through and passing 3 tests and getting 3 letters, and look at it more in terms of, how is this going to improve my job performance? How is this going to make me better at my job? How does this apply to the job that I'm doing, and how do I translate it from words into action? If you take that pathway, the mediating variable, as I said, is job performance. And if you take that pathway, passing a test is secondary. You will pass the test. Listen, in my undergrad, every semester I would sign up for my courses. I never once signed up for a course saying, well, I hope I pass the test. What do I need to do to pass the test? I don't think I ever once asked that question. Passing the test was almost a given. I wasn't going to fail. That wasn't going to happen at all. It was a question of, how well will I know it? Not how much do I need to know, but how well will I know it? Will I know it on a level where suddenly I see it, I see the connections, I see how it applies, or will I kind of understand it? But passing a test was never in question. There was never, ever a time where I thought, oh, well, maybe I'll fail this course, but I need it, so I hope I pass. And never once did I sit at the beginning of the class with my hand up saying, do I need the book? Are your slides enough? Do I have to attend class? I never once negotiated at the beginning how little I had to do, because that misses the point completely. You're not there to pass the test. Passing the test is evidence that you know this stuff and that you can apply this stuff and that this stuff will matter in your career. So hopefully that gives you a different perspective on how to look at things. I do encourage you to go to the Applied series and have a look at what you can do, what you can achieve by knowing this stuff, and maybe that might give you the motivation and look at this in a more applied and practical way. So, to answer the question, is the charter worth the effort? The answer is very simple. Only if it improves your job performance. If it doesn't, the answer is a resounding no, it is not worth the effort, as nothing would be worth the effort.